Hey everyone, welcome back to Corporate Decoder, the place where we break down big company filings and find the juiciest bits. So, First Choice Healthcare Solutions is doing something a little surprising with their latest filing. They're essentially saying, out with the old, in with the new, and they've got a whole new strategy they want us to know about. Let's dive in and see what this pivot really means. Before we start, if this is your first time here, hit that subscribe button. We uncover the real stories behind these corporate documents so you don't have to. And if you want to connect with other finance enthusiasts and get live insights, join our Discord community linked in the description below. This filing is essentially a big announcement about a pending stock offering, trying to raise a bunch of money, around $12 million. With the hope of listing on the NYSE, it is a bit complex, involving preferred stock and warrants. But the core idea is they're raising capital to make some big changes. The company First Choice Healthcare Solutions, or FCS, is really trying to move away from its old orthopedic business. They're talking about a big strategic pivot, shifting gears to focus on primary care and wellness clinics. Think anti-aging, weight management, and pharmacy services. They even plan to cut ties with most of their remaining old orthopedic services. This is a bold move, especially after going through bankruptcy back in 2021. Now, this bankruptcy wasn't some minor hiccup. It stemmed from criminal charges against their former CEO, which really hit the company hard. It forced them into bankruptcy, and it has taken a few years to reorganize and get back on their feet. They're trying to signal that the past is behind them and they're looking forward. Their new strategy involves these primary care and wellness clinics, but there is a catch. A big part of their revenue projections, about 15%, comes from what they call quality of life services, things like anti-aging and hormone therapy. The kicker is these are mostly self-pay services, meaning they're not covered by insurance. This is a risky bet because it relies heavily on people being willing and able to pay out of pocket, which could limit their growth or force them to offer discounts, impacting their bottom line. Let's get straight to the juicy part, the financials. Since they started, this company has not been profitable. Looking at the 9 months ending the 30th of September 2025, they had losses of around $3.5 million, and back in 2023, those losses were even bigger, over $8 million. They have a massive accumulated deficit, meaning they've lost a lot more money over time than they've made. This is a huge red flag, and it's why they're so focused on raising capital. And it is not just about past losses. They're pretty upfront that if their cash from running the business isn't enough to cover their bills and debts, things could get really bad. They need more money to expand, and if they can't get it, they might have to scale back or even stop operations. It is a classic case of needing funds to survive and grow. Now, looking at the numbers for Point Medical LiveWell Group, which seems to be a part of this whole operation, things look a little different. For the 9 months ending the 30th of September 2025, they actually did have a net income around $514,000, and for the full year 2024, they reported over $1.4 million in net income. This is a stark contrast to the FCA's numbers, and it suggests the acquisitions they've made are performing better financially. But even in the Point Medical LiveWell Group numbers, there are things to watch. There is a significant collateralized loan, over $1 million, and a substantial amount of SBA loans, more than $4 million outstanding. While they are profitable, they are still carrying a good chunk of debt, which is always a risk. Okay, let's talk about the stock itself for a moment. They're planning a 1 for 2,000 reverse stock split. That is a massive split, meaning for every 2,000 shares you have, you'll end up with just one. This is often done to boost a stock price and meet exchange listing requirements, but it also means your ownership stake gets drastically reduced. It is a way to get their stock price up so they can list on the NYSE, but it is important to understand that your actual number of shares will shrink dramatically. The offering itself is for Series D convertible preferred stock and warrants. These preferred shares can be converted into common stock, and the warrants give the right to buy more preferred stock later. The terms are pretty complicated, with conversion prices and exercise prices set at $5 per share. A big risk here is the anti-dilution provisions. If they issue more stock later at a lower price, they might have to reduce the conversion price on these preferred shares. This could mean a lot more shares are issued later, diluting existing shareholders even further. They even mentioned they might not have enough authorized shares to cover these conversions, which could force them to increase their authorized shares, a costly and time-consuming process. The underwriters for this offering are RBW Capital Partners LLC, working through Dawson James Securities Incorporated. They're getting a pretty hefty fee, around 8% of the gross proceeds, which is standard practice, but it adds to the cost of the offering. Remember that former CEO's legal troubles we mentioned? It is a risk factor they keep bringing up, and understandably so. It clearly damaged the company's reputation, and likely its business relationships. They are trying to show they've moved past that. They're also identifying themselves as a smaller reporting company. This means they get to follow less strict disclosure rules, which is good for them, but it could make investors a little wary because there is less public information available. It is a double-edged sword. Now let's talk about dividends. They haven't paid any dividends in the past and have no immediate plans to. So if you are looking for income from dividends, this is probably not the investment for you. They plan to reinvest all earnings to grow the business. Looking at their corporate structure, they have provisions in their governing documents that could make it harder for someone to take over the company. This is pretty common, but it can sometimes make it tougher for shareholders to benefit from acquisition offers if management is resistant. Back to the strategy, they're really banking on these primary care services, making up about 85% of their clinic revenue. The other 15% comes from those self-funded quality of life services. The success of this whole pivot hinges on whether they can execute this new strategy, acquire these businesses smoothly, and attract enough patients to these new clinics. The market they're entering is definitely competitive. They're up against virtual competitors, brick and mortar clinics, and even specialized private practices. They believe their integrated approach combining primary care with specialized services and their own pharmacy will give them an edge. But it is a crowded space and success is far from guaranteed. They're pointing to an experienced management team as a key strength. Lance Friedman, the CEO for example, has a background in corporate and capital markets advisory. The new hires for CUO and CFO also bring relevant experience. Having the right leadership is crucial, especially for a company trying to turn itself around. The ultimate goal is to get listed on the NYSE. They've applied for the ticker symbol FSHS. If they get approved and meet the listing requirements, it could give them more credibility and access to capital. But there is no guarantee they'll get that approval. So what is the verdict here? First Choice Healthcare Solutions is making a dramatic shift, ditching its old business to chase the primary care and wellness market. They've got some interesting acquisitions lined up, and on paper, one of those acquired entities is showing profits, which is promising. However, the parent company FSHS is still in deep financial trouble, with massive accumulated losses and a reliance on this offering to even get off the ground. The anti-dilution clauses in their preferred stock are a big red flag for potential investors, as is the heavy dependence on self-pay services for a portion of their projected revenue. It is a high-risk, high-reward scenario. They need this offering to go through to fund their ambitious strategy and achieve that NYSE listing. If they can execute their plan and overcome the risks, they might have a shot, but it is a big if. Investors should be very cautious and understand the significant uncertainties involved. What do you guys think about this big pivot and the financials? Let us know in the comments below what you think of FSHS's strategy and their chances of success. If you found this deep dive helpful, please give it a thumbs up. It really helps the channel, and make sure to subscribe for more breakdowns like this. And don't forget to join our Discord community for more direct insights and discussions. Thanks for watching, and we'll see you in the next video.